Municipal bonds. The previous chapters have considered, in turn, the investment value of railroad bonds, real estate mortgages, industrial bonds, and public utility bonds. The desirability of each of these different classes of security has been judged in accordance with the general principles laid down in the introductory chapter. That is to say, each class has been analyzed in relation to safety, rate of income, convertibility, prospect of appreciation in value, and stability of market price. The same determining factors must now be applied to a judgment of government, state, and municipal bonds. Bonds issued by a national government, by a state, or by a municipality are based primarily on some form of the power of taxation, though the bonds are usually tax-exempt within the political unit which creates them. When the power of taxation is unlimited, as in the case of the national government and the sovereign states, there can be no question as to the ability of the political unit to meet its obligation, and the question becomes entirely one of good faith. It is probable that the obligations of the United States government, by reason of the fact that the per capita debt of the country is so small, the wealth of the country so great, and the good faith of the American people so clearly established, represent the highest type of security to be found in the world. It is quite possible, therefore, that a two-person United States consuls would sell in any case at a relatively higher price than the obligations of any other country. But it cannot be denied that the chief reason which causes them to sell at the remarkably high price which they have attained is the fact that they are required by national banks as security for circulation. This fact is doubtless the controlling element in their market position, and at once accounts for their special strength and removes them from the field of private investment. Only less secure than United States bonds are the obligations of the sovereign states of the Union. State bonds usually sell upon a basis which may be taken as the equivalent of pure interest with no element of risk or speculation involved. The obligations of different states sell at different prices in accordance with market conditions and the relations of supply and demand, but there can be no question of the equal ability of all states to pay their obligations. Repudiation of state debts has occurred in our history, but only in cases where an overwhelming majority of the citizens were opposed to the creation of the debt at the time of its issue, but lacked the means to control the situation. Such instances are chiefly to be found in the case of the so-called carpetbag governments of the southern states after the Civil War. Municipal bonds, that is, the bonds of cities, counties, and townships, are indirectly a first lien upon all taxable property in the municipality and take precedence of every form of mortgage or judgment lien. This lien is enforced through a tax levy to meet interest and principal, and this tax levy the courts will compel in the rare case in which a municipality attempts to repudiate a valid bond. This priority of the tax lien is the foundation of the prime position of municipal bonds. The case rarely occurs where a bond held valid by the courts proves uncollectible if sufficient taxing power existed when the bond was issued to provide for its redemption. It is only when the municipality itself diminishes in population and taxable property to the vanishing point that such a default can occur. An investor can judge for himself as to the likelihood of such a catastrophe in any particular community and can feel sure that his bond, if valid and protected by a sufficient taxing power, is as secure in its principal and interest as the municipality which issues it is secure in its continued existence. The following are the chief points which should be considered in the investigation of a municipal bond. First, the proportion which the total debt of the municipality bears to the assessed valuation of the property subject to taxation. Usually a maximum rate is fixed by constitutional provision which rarely exceeds 10%. Second, the purpose of issue. This must be a proper and suitable one. Third, the proceedings under which the bonds were issued. These proceedings, the form of bonds, their execution, and their legal details must be in full compliance with the law. If these points are found to be satisfactory, the investor may rest content that no other form of security is so greatly safeguarded and that his bond ranks upon a substantial equality with government and state obligations. The rate of income to be derived from investment in municipal bonds varies in accordance with the obligations selected. Like other forms of security, municipal bonds are controlled by market conditions, and their price is determined by the relations of supply and demand and by adjustment to prevailing money rates. While differing only moderately from one another in point of safety and income return, municipal bonds may be divided into two distinct classes in accordance with the degree of convertibility which they possess. Some municipal bonds possess great convertibility, others almost none. The feature which chiefly determines the activity or inactivity of a municipal issue is the size and importance of the municipality, together with the amount of bonds which it has outstanding. The bonds of large and important cities, whose outstanding debt reaches considerable proportions, usually possess great activity. They are constantly traded in and command a broad market because dealers are willing to buy or sell them in blocks at prices within a fraction of 1% apart. On the other hand, the bonds of counties, townships, and small cities are usually quite inactive. Transactions rarely occur in them, dealers do not make a market in them, and they can be sold only to genuine investors. It is often impossible to have them even quoted. At first sight, it would appear that active municipal bonds would be much more desirable. But inactive municipals possess a special advantage which the active ones do not enjoy. They possess more stability of market price. It is true that their stability of value is due to the fact that they are not traded in or quoted and is therefore largely fictitious. But nevertheless, it accomplished a useful purpose. It enables the investor to carry inactive municipals at cost price upon his books through periods in which active market bonds would require to be marked down in conformity with prevailing market prices. No other class of investment except real estate mortgages possess to the same degree this quality of price stability. For many classes of buyers, savings banks, for example, stability of price is a consideration of prime importance. The preservation of the savings bank surplus and, indeed, the continued solvency of the institution depend upon maintaining the integrity of the principal which it has invested. A savings bank requires also great safety of principal and interest, that is, the certainty that principal and interest installments will be paid at maturity. It needs only a fair but not high yield, and it does not need to place emphasis upon convertibility or prospect of appreciation in value. Comparison of these requirements with the characteristics of inactive municipal bonds discloses a striking adaptability on their part to the real needs of the case. As a consequence, it is not surprising to discover that inactive municipals are greatly sought by savings banks. The desirability of inactive municipals for savings bank investment was never more forcibly illustrated than on the 1st of last January, when the savings banks came to make up their annual statements. Broadly speaking, there can be no doubt that they were saved by the large quantity of inactive municipals and real estate mortgages which they carried. Had any considerable portion of their assets consisted of railroad bonds and active municipals, upon which they should have had to write off a loss of 10 to 15 points, their solvency would almost certainly have been impaired. But we are chiefly concerned in these pages with the advantages and disadvantages of different forms of investment from the point of view of a businessman, both for the investment of his business surplus and of his private funds. Do municipal bonds, either active or inactive, conform to the requirements of the business surplus? It cannot be said that they do. Municipal bonds possess either convertibility without stability of price or stability of price without convertibility. Both qualities are necessary for a business surplus. The only form of municipal security which is at all adapted for the investment of a business surplus is a short-term issue of an active municipal bond. If it has only a very few years to run, its constant approach to maturity will invest it with the necessary stability of price. But even in this case, equal safety and equal stability of price combined with a higher yield can probably be found in some high-grade railroad issue, either a short-term mortgage or equipment bond. For private investment, the case is somewhat different. Enough has been said in the preceding chapters to impress upon the listener the importance of buying securities only in accordance with his real requirements. If any investor, after careful comparison of the characteristics of municipal bonds, either active or inactive, with his necessities, decides that he can more closely satisfy his requirements with municipals than with any other form of security, he should not hesitate to purchase them. It is the opinion of the writer, however, that a thorough survey of the field of investment will generally disclose to the investor some security in either the railroad or corporation field, which will suit his requirements, as well as the municipal bond